So with me today, I've got Corey Petty, the chief evangelist at Logos. I don't even know what that means. So let's start there. What is a chief evangelist and what is Logos? Start from the very beginning for folks.
Yeah, let's see where to go. My job, I've spent a number of years. I think I'm at 8 or 9 years with this organization, and the organization has grown a number of times since it began as a project called Status, which was, we can get to the terminology later, but it was an early ICO, initial coin offering in the Ethereum space, which then grew and stuck around and grown and evolved over the years as the industry has grown too. And so I started there as the chief security officer, and my job was anything that had to do with security, whether it be like appropriate asset management, cryptography, the code reviews, negotiating audits, anything like that. I was in charge of handling or figuring out how to handle. And that meant I had my fingers in everything. I had to touch base with the entire part of the organization. And I've kind of had that position ever since I started with them. And as it's grown, I've continued that. And so now it's gotten to the point through iterations of me trying different things throughout the organization. It's like, all right, well, find gaps in understanding and what's going on. You know everything about the organization. You know why we're here. You know what we're trying to do. You have some technical acumen. Find gaps and fill them. And so the best role we could really come up with that had a name was evangelists. That's what I do now.
All right. So you've already said a lot of things that even myself doesn't quite understand. So let's go back to the beginning. We really, we've heard Ethereum. That's one of the more popular cryptocurrencies that I think a lot of people have heard of, obviously that in Bitcoin. But let's go back even further than that and just establish kind of what some of this stuff is. So at least in my world and the conversations that I have with clients, crypto is this thing, this idea. Most people look at it and they say, can I make money at it? Is it gambling, right? So sometimes when I'm talking to investors or people who are early on in their investing career, they talk about the stock market as investing, talk about the stock market as gambling. And so we have to step back in the education process and say, well, actually, it's not gambling because the stock market is a representation of real companies that are adding value to the economy, right? And so if we take that approach and we're talking about investing as not just putting money in the market and hoping that it goes up and hoping it doesn't go down, right? It's not a roulette wheel. Can you contrast that? Let's start with just cryptocurrency in general, because I think it's easy for folks who have heard a lot about it, right? We've seen the huge swings in cryptocurrency prices. And let's start with just talking about Bitcoin, because that's one of the original ones that everyone heard about. Just a few years ago, it wasn't worth nearly as much as it's worth now. Just a few months ago, it was worth significantly more than it is as we record today.
45% or something.
Right. And so that's what most folks have the experience hearing about. But let's start with, what is cryptocurrency in its most basic form? Where did it come from? How does that contrast to what we know as our own fiat currency and what we live in, and kind of the origination of cryptocurrencies, the thought process behind that, et cetera? Let's start there.
So first you need to decouple the technology, which is either called like cryptocurrency or blockchain or distributed ledger technology, whatever, decentralized networks, these things, from the assets that technology enables, which is Bitcoin, Ethereum.
Okay, so which one which one comes first? Is this a chicken or an egg thing?
I'm gonna explain the technology and how it enabled,
because that's first,
the asset to exist.
So that's even before we have a Bitcoin. That's before we have an asset. We have this technology.
Kind of.
Yeah. So let's start at the very beginning, as far back as we can with that.
Yeah. So it started out with, even before Bitcoin existed, there was this field trying to make e-cash, digital cash, in a way that was remove the middleman from the system. So in most settling systems where you have to exchange value, you say, I want to give you some dollars. We have to go through some intermediary,
like a bank, a credit card,
something like that basically that gives it the stamp of approval. They're the ones that maintain the ledger that keeps track of who has what. That's always been a human in the past. We've never been able to build digital systems that remove the human from the loop. And why do you want that? You want that due to this problem called the double spend problem, meaning that in all previous electronic systems, I could give you something and there was no way for you to know that I don't have it anymore and I didn't give it to someone else too. right? So when we had the internet explode, we had this proliferation of information. I can give you a copy of something. There was no way for you to know, based on how the digital system worked, that I no longer have it.
And even before that, a more crude example would be writing a check, right? So even before we
Yep.
had the internet, I could write you a check today and you had no idea whether there were any funds in the account that I was writing
Had to
that
get it
check on.
cleared.
Right. So we had to get it clear. So there was holds and there was people that were floating checks, right? Where payday was tomorrow. I could write a check today and hope that you didn't catch it.
Post-date it to make sure you couldn't, or things like
Post-date it,
that.
right? So that was even more crude. And then we have this internet system where now it's a little bit more real time, but we still have this double entry system where we're checking on both sides.
I mean, even when you think about the stock market and Wall Street, it's still like T+1. It's still like trade plus some time for it to clear.
That's right.
Which slowed down the I guess the speed or velocity and how fast you could move things around. And so when Bitcoin came along, it was the first time that it solved this double spin problem, where we built a system through a process called distributed consensus, which is a little more complicated. We can explain that later. But basically, we found a way for a bunch of nodes in a network to agree on something without a middleman, a central authority to say this is the answer. And once we have that, we were able to create digital scarcity. First time in the world, we were able to, without a doubt, know that if I gave you something, a digital something, I no longer have it. And there's a record of that. You don't need a central authority to prove it.
So define digital scarcity.
Exactly that.
Okay.
It is a scarce asset. How scarce it is, that's arbitrary at this point. So for Bitcoin, it's 21 million Bitcoin ever to exist, based on basically how the software comes together. But proof of how much is in existence, how things can be created, how things can be destroyed. So you have this digital scarcity and you can trade it now. And so that's the first time we could create something like that. Everything else was just like, you can make as many copies as you want. There's nobody that can stop
We
you.
can print more.
And a good example of that is like BitTorrent. You remember like Napster and all that type of stuff?
You download your music.
Yeah. People were just making copies and copies and copies, but there's nowhere to stop that or safeguard it. This was the way to actually create a digital scarcity. And without a shadow of a doubt, that there's this many in existence. This is who has them. And there's a very fair and governable process on how those things trade within that network. And so, okay, cool. We've figured out how to make digital scarcity. What can you do with that? Well, money is a really good first application. That's what Bitcoin is.
So is this the idea that we used to have where our currency was backed by gold?
Yeah.
At that point,
gold was the scarcity.
We had a finite amount of gold, and our currency was representative of the amount of gold that we had
in some bank somewhere. The checks basically as there's like IOUs. I'm keeping it because moving around gold is really cumbersome and awkward and difficult, and it's hard to test and all those things. So you give it to someone who can hold it with some level of security, and they say, "Oh, cool. Here's a check that I've signed or put with some, wax seal that verifies that you have this much gold in this bank account." Then you could pass those around,
right?
And that became kind of the next step of money. But we never figured it out digitally. And as the infrastructure for the internet grew, we've relied so much more on digital information and digital e-commerce and things like this, but we never had a currency for the internet or a way to even do currency. And so Bitcoin was the first time in which we figured out how to do something like a native currency for the internet. And then since then, the whole ecosystem has exploded in terms of experimenting with all the different ways you can then leverage digital scarcity. And that's why we have like all these different currencies, all these different networks, because
they're all based on the same premise, that there's a digital scarcity, a finite amount that we can know. All right, so we've created Bitcoin now. We've got this digital scarcity. What comes next?
Sure. The whole point of value is you have a number of people that agree that this is the thing we're relying on. That's why the current fiat has value at all, is because the government enforces it. You can pay your taxes with it. We've agreed that it's what I can use to do certain things. And the more agreement you build up, the more use cases you build on top of this asset, the more value and confidence you have in that value over time. So I can build a cryptocurrency now. Thousands are built every day, but no one cares because no one uses them, relies on them, or builds businesses and infrastructure that leverages them. And so that's really where we're at now, is you could build digital scarcity however you want. But if you can't get a group of people to come together and use it and rely on it, then it will never have value.
It just comes down to marketing, basically.
Yep. And real businesses, like you need to convince people to have confidence in using this thing. It needs to be useful for them. It needs to have some stability. It needs to have things. So there's a lot of ways in which we can dive into why the things that have value today have, and where it can go from there. But like that's a general idea now. It's like it's an open field, and now it's about getting people to actually use them and rely on them and build.
So if someone is buying Bitcoin or Ethereum or any other cryptocurrency today, is that effectively like a foreign exchange?
Yeah.
Same thing as if I were to go exchange my dollars for yen or for
100%.
pounds or whatever. It's the same concept.
Yes, but it's a bit more open because it's less regulated. It's less like, if I do a foreign exchange, I at least understand that there's a country that is backing this thing. The stability of that country it calls into question on the value of that then, right? So the US dollar is the global currency because people trust the backing and stability of the US dollar
The US government.
and US government.
Yeah.
That type of risk assessment has to be done for cryptocurrencies, but they're not necessarily backed by a government or anything. And so how you go about doing that due diligence becomes more difficult.
So then why does Bitcoin have any value if it's not a fiat currency?
Because it serves a lot of different purposes, and it's kind of like the Kleenex of cryptocurrency. It's like the first one that existed. It's the largest, so it has a lot of value behind it. It's been battle tested for a very long time against very large adversaries to try and break it, and it has yet to be broken. And there's a lot of infrastructure that's built on top of it. And it's kind of been battle hardened throughout the 11, 12 years that it's been in existence
Okay.
and grown.
So you say been a lot of infrastructure built on top of that. Now I feel like we're moving to something else, because when I think about the US dollar, I don't think about infrastructure being built on top of it. I just think of it as an agreed upon thing that we trade, that we've applied or assigned a value to. So when you say Bitcoin has infrastructure built on top of it, what do you mean?
So ETFs are a good example here.
Okay. So exchange traded funds, like what we're used to.
Yeah.
Okay.
So for the longest time, this has a number of consequences. Bitcoin's market cap was relatively small compared to traditional finance because it was still risky for traditional finance, and there were no vehicles for them to put money into this ecosystem because traditional finance is much more regulated. How you can add Bitcoin onto your balance sheet requires some, I guess, rules and regulations on how you do that. ETFs were the first vehicle, really, that allowed for large-scale institutional finance to start playing with this type of thing. And so now, since the first ones, we've had a tremendous amount of money flow into the market of Bitcoin and cryptocurrencies. I call that infrastructure. Like businesses are now putting a portion of their balance sheet in this technology. In the past, it used to be a nice hedge against the traditional financial infrastructure because it wasn't necessarily tied to it. So some people put, like, independent people would put portions of their portfolio into Bitcoin and Ethereum and other currencies as a way to hedge against the traditional market. That's not necessarily the same story anymore because the traditional finance has pumped so much money into it. But like businesses now on all of those ETFs use things like Coinbase. So Coinbase is Coinbase Custody, which is a portion of the Coinbase company in California. We have all these businesses that leverage Bitcoin and then help people use it. And we've had countries use it as a way, as a national reserve currency. So there's so many things that happen over the course of the lifetime of Bitcoin that have relied on Bitcoin to be there and to be reasonably stable in terms of functioning, that you get more and more confidence that's going to work, that's going to be there. And that's kind of the calling card now for most cryptocurrencies is you want to make sure that if you're going to invest in this type of stuff, that you have confidence it's going to be there later on down the line.
Yeah, for sure.
So when I look for value or why things have value, I look for businesses that rely on it. I look for situations where large scale companies are relying on it being there in the future. They've made a bet that we're going to put money here or value here and park it for a little while because we're confident it's going to be there later on down the line, whether it be the same or more, but it's a different story, but like, they're confident it's there.
Right.
And they do business based on that bet. And if you can't really do that, then you're going to have a hard time experimenting with the ecosystem.
Okay, so we've got this piece of it, but then the other piece that kind of goes hand in hand is what we hear about all the time in blockchain technology. So tell me how cryptocurrencies, like what we just talked about, in blockchain technology are related. And then what, but before that, what exactly is the blockchain and blockchain technology, and why do we care?
Great. So taking a step back and just looking at the idea of the blockchain. Blockchain is just a data structure. It's a piece of technology that quite literally chains blocks together. So the way you interact with the blockchain is you pick a message. The message is effectively like, I give Blaise 1 Bitcoin. I'm going to write this out in the language of whatever network I'm using, Bitcoin for this example, and then I'll digitally sign it. So that way it's guaranteed through cryptography that I wrote this message. Whoever owns the private keys, that's what you hear about private keys and wallets. Whoever owns those keys signs the message as an indicator of like proof that can't be falsified. So I sign this message, I'm going to send you some Bitcoin. And then I submit it to the network. And there's things called validators that will then check that to make sure all the details are right. That checks my balance to make sure that I own this particular coins that I'm giving to you. It checks your address to make sure it's a good address. All these types of things to say, yep, that's a valid thing. And then it puts it into like this pool of potential transactions that haven't been added to the block. And then every 10 minutes for Bitcoin, some winner, we can get to how that happens later if you want to, but some winner basically gets to add the next block. And so they'll add whatever transactions that are in this pool, pack them up in this block, and then submit it to the network. And the network checks it to make sure that they did all that process correctly. And then that's the next, those are now confirmed transactions. Now it's much more, you can be much more sure that you own those Bitcoin now. And as that process continues on, as blocks get built onto that, as that blockchain continues, then your confidence in the fact that that can't ever change again grows more and more and more. And there's some interesting details on why you can have that confidence, but that's the general idea. So you have this, what that gives you is what's called tamper evidence. If I changed a transaction and block any transaction in history, and all you're doing is looking at the last block, you'll be able to see that change immediately, not ever having to care about the rest of the chain. And it's done through the way the fun tricks we're doing with cryptography. You can be sure that nothing has ever changed just by watching the head of the entire chain because of the way cryptography changes everything. And so now if somebody tries to change things, you can immediately know with almost no work. So you have this like transparency and tamper evidence. And then the game we play for who gets to add what block to the chain, that process of adding transactions to the ledger, is incredibly fair and incredibly hard. You can't cheat it. And it requires a lot of work. And the rules of the game are set up such that you're overwhelmingly within the benefit of playing by the rules than by cheating them. So not only is cheating going to get caught immediately, it's also incredibly costly and you don't get much out of it. And so we have this game where we have a network that can add transactions to a ledger, and we are very, very confident that that process is done fairly. And when it's not, we can see it immediately.
Okay, so you have said ledger and all, but we talked about getting away from this middleman, but it sounds like there's still a middleman in the blockchain.
The middleman is the group of validators. It is what's called the decentralized consensus protocol.
So how is that different than a middleman in our current banking system?
There's a number of ways. One, it's not one person, it's a group of people. The participation, well, we're going to stick with Bitcoin because that changes based on the network. Participation in that is fair, meaning that all you need is energy. I can participate in the consensus mechanism and have a chance to be the person that adds the next block.
So when you say fair, it means anyone could choose to participate in this. It's not like you have to be selected. It's not like it's one group. Anyone who has the energy, and I want to touch on that in a second because we've heard a lot about data centers and energy and all that, but anyone who has the ability to do this then has a chance to do it.
Correct.
Okay.
Fair chance based on what they're contributing to the network.
Okay. So tell us a little bit more about that. When you say a fair chance contributing to the network, energy, kind of help me understand.
Yeah, so the process, we're going to stick with Bitcoin once again. That's a whole scientific field now.
Okay.
It's blown up since then. But the game you're playing is effectively, my favorite analogy for this is it's a one giant Sudoku. And so you think about doing a Sudoku, it's kind of hard to do. It takes a while to figure out. It takes some time and mental effort. But the moment you finish it, you can give it to me and I can be like, yep, you did it right, with almost no effort.
Everyone can check the same answers.
Check the same
100%, yeah.
answer. Like what it means to be correct is straightforward, but the process of actually doing the puzzle is hard. So solving the Bitcoin mining problem is that, but the Sudoku is absurdly massive. And it's not actually Sudoku, it's just an analogy. And so what we had, so we use computers for it. We have very specialized computers that solve this one problem really, really, really hard. And the first one to solve it gets to submit their proof. Like, hey, I solved it. And they submit their proof and the block, and everyone goes, nah, they got it. On to the next one.
And is that the actual Bitcoin mining?
It's mining.
Okay. So why is it called mining?
I don't know. I think there's just early days wanted to have that analogy of like we're searching for the next thing, because what you're doing is you're searching for a specific value as you solve this Sudoku, this mathematical problem. You're actively trying and brute forcing this problem over and over and over and over again until the answer becomes a specific value. And then once you get that, you're like, I found it. So like that kind of process of like searching for something and then finding it.
Finding
and then,
around for it.
Yeah.
Okay.
It came from there.
Okay. So we've got this blockchain technology. How is that related to the currency? Because those sound like two different things. I mean, I know we're trading our Bitcoin. Let's stick with Bitcoin back and forth. But the blockchain technology can also be used for things outside of just the coin, correct?
Yeah. So what you've done is you found a way for a group of computers to agree on something. And some of those computers can be adversarial, meaning that they can be actively trying to damage the network. And the group of computers can still come reliably to the correct answer and move forward. That was one of the main things that we were able to solve, was called distributed consensus. Once we have that, especially in this adversarial setting where anyone can participate and some of those people are maligned, then you can build a bunch of interesting things, because what you come to agreement on is kind of arbitrary. But the easiest first application of that was money.
Okay.
But like also because you have this weird tamper evidence property of the chain, you can do other things like timestamping information, because you know that people can't change the history of this blockchain based on the process of how it's created. I can just I can make something and then stamp it into my transaction through some like extra fields that exist that says like I did XYZ. And then when that transaction gets included, I can then point to it and say, I did this thing at that time, and no one can ever falsify that type of thing.
Or dispute that.
Yeah. And so then it becomes this like interesting way to deal with all kinds of things you'd like to prove that happened. And that's where you get into technologies like Ethereum, which allowed you to do more of that type of thing.
And so Ethereum is another cryptocurrency, but also another type of blockchain technology.
So what it did,
same concept
in
general, okay,
Yeah.
as Bitcoin.
Yeah, you're still basically having a network of computers that understand how to agree on things, that then move this chain along of transactions that change the state of what people care about. What they introduced was this concept called smart contracts, which was
This was Ethereum.
So
introduced.
Bitcoin it can do a few extra things, but majority speaking, the way in which the rules you have to use within Bitcoin that are valid are really limited to me giving you funds.
Okay.
There's a couple extra things you can do with like moving funds around, but not too much.
So Bitcoin really was designed as a currency.
It was much simpler in
Okay.
terms of, and that was by design.
And that was what they were solving for.
Yeah.
Okay.
But Ethereum wanted to expand that and make it more like a general computer. And so what it introduced to smart contracts which gave you kind of arbitrary business logic. So instead of just saying like, I give you 2 Bitcoin, it can say, if this happens and this happens, so if X, Y, and Z happen, then allow for this amount of coin to be moved. So you can add in a bunch of arbitrary business logic and embed that into the blockchain. So that way, under certain conditions, things can move. And the language you have is very rich. You can do really complex things, but the more complex it gets, the more expensive it gets. So like your transaction becomes more expensive. And so now you have this balancing thing of like, what's the proper thing to embed into the blockchain that I need to be true and tamper evident, but then gives a lot more functionality into what you can actually do with money. And now you can start introducing concepts like governance or permission control and some more advanced financial tooling that happens under certain conditions.
This is where Ethereum can do this, but the Bitcoin blockchain could not.
It's much more difficult, much more expensive, much more cumbersome to do that in the Bitcoin ecosystem.
So what are we seeing the most practical applications currently being used for Ethereum, and were those first level of applications once Ethereum was kind of created and you had this more advanced stability?
One of the larger things was called the DAO, which I happen to be involved in and a part of I guess, white hat hacking of when the DAO got hacked at
So
Ethereum.
we're talking about not the Dow Jones Industrial Act,
No, this is the Decentralized Autonomous Organization.
DAW.
Yeah. So that is effectively a community-based management of a fund, of a treasury.
Okay.
So here's a treasury, and based on the votes, and you can weight those votes in some arbitrary way. Based on the decision of certain votes, you can manage a treasury and have it automatically pay out for certain things. And so it allowed for this kind of like democratization of governance on a treasury. And that was all built with smart contracts in the early days. And so now you've introduced this idea of kind of collective control over funds.
Okay, but let's go back to the DAO. Like, what was that used for? Okay, great, you can do that. But like, what was the practical application?
They wanted to build basically a fund that the Ethereum community managed on what projects get funded. So we all had, at that time,
Real project.
Yeah, real world projects trying to make things.
So like, for instance,
there was a project that started it called Slockit. And what they were trying to build was,
I love these names. Like,
I mean, you don't even, it gets wilder and wilder and wilder. This was still long ago.
Yeah.
They just wanted to have basically, I'm trying to find a right way to say this, digital locks.
Okay.
In which if I paid money to a smart contract, it gave me access to that lock. So if you think about like an Airbnb type of situation and I rented a place, I can then manage my access to this thing via Ethereum and payments on Ethereum. I can just pay funds to this smart contract. It then gives me access to a lock that I can then unlock and use for a specific amount of time. And all that stuff is kind of set up and automated versus having some central management firm deal with access control and that type of thing.
So like a rental company that actually takes the payment and then
does it all built into the same platform.
So quite literally, that's a great example where we remove that middleman of a management company or somebody.
Yep.
And you just send your Ethereum payment to the other party and they literally unlock your door.
Yep. Completely auditable, transparent. You can check the security of everything before it works. You can see where the money goes, all that type of stuff. All the auditability of these things has been one of the hallmarks of why people like it too, is that you can see where the money goes.
Okay, so now Ethereum is also one of the more popular cryptocurrencies and blockchain technologies today. There's a lot of stuff built on it. What are we seeing the most practical applications being used today? What are those folks walking around who don't really understand this stuff? How are they maybe interacting it or with it, or maybe, adjacently touching this stuff?
So there's a couple terms that have come out that I think people are starting to hear, interact with more often, and that's DeFi or decentralized finance. So a good portion of the ecosystem has an effort to basically rewrite the rails that control Wall Street so that you have a more efficient way of moving funds around. And that deals with that kind of like T+1 or T+3, the transaction plus.
So shortening the time of that.
Making the whole system more efficient and transparent and auditable.
Because if both sides can agree that this transaction is 100% accurate, you can just keep moving.
You don't have to wait for somebody else to give you information and then question the quality of that information. You have a public good reference with a lot of confidence that it happened.
And how quickly are these blocks on the chain being validated?
That depends on the network. So
let's say Ethereum, because we're talking kind of about
Ethereum. I think at this point is like, I want to say, I forget what the actual timing is now, but it's steady at somewhere between 6 and 12 seconds.
It's done. That transaction can be validated and put on.
Yeah, and then there's a time period. There's some subtleties on how consensus works. So Bitcoin is every 10 minutes, and you can be confident that it's never going to change after 6 blocks. So it's about an hour. So within an hour, you can be fully confident that no one can ever change that block ever again. Ethereum, I think, is closer to 12 seconds and a couple minutes for that same level of confidence.
And you're done forever,
And you're pretty confident it's not going to move again.
99%, like 2 standard deviation.
It takes the wealth of a nation to move it for maybe 1 transaction.
Okay.
And it's still, once again, evident.
So Ethereum took the blockchain technology of Bitcoin and improved the efficiency of it.
Its effort was to scale it, improve efficiency, generalize what you can do to it.
Is that a good way to kind of describe that?
So people like to use Bitcoin as like, and these analogies are a bit wishy-washy, but the best there is like Bitcoin is like digital gold.
Okay.
And that there's a limited supply. The amount of that, like the ability to change that is very, very, very difficult. And it doesn't do much. It's more of a storage of value and a scarce asset that it doesn't have a specific jurisdiction you can rely on. where Ethereum is closer to like a generalized computer, where the asset you use is like gasoline. You're using Ethereum, your ether, to then fuel the network to process transactions like a computer would. That's a better idea of looking at it. And then Solana was an attempt to amplify the efficiency of the thing.
All right, you jumped ahead now.
Yeah. So like there's a couple like, and so now you have all these different networks that work in different ways, and it becomes confusing.
It's from Ethereum to Solana since you introduced Solana, because that's, in my mind, kind of that third tier. Like it's still one of the more popular ones, right? It's not a meme coin, right? These things that are just completely, have no value. But Solana, how does that fit in with, we've got Bitcoin, the OG, right? That's the gold in Fort Knox. Then we've got Ethereum, which is, we're actually going to do something with this technology. Now we have Solana. How did that iterate?
Solana was an attempt to make an effectively a high frequency trading platform based on this technology.
So
they wanted to make
go
as fast as possible.
Specifically in the financial sector?
Yeah.
Okay.
I mean, they wanted to make an incredibly fast Ethereum. So they had to change the way in which it works, which lowers the kind of democratization of participating in the process of making Solana go. The infrastructure you need to run the network is substantial, meaning like you need significant capital to participate. It's closed, it's permissioned, and that there's a process of even just asking or getting the permission to participate in the consensus of this network.
Doesn't that kind of go against the whole idea of
and it's like a scale, right?
Yeah.
Where you have Bitcoin and Ethereum, where Bitcoin is arguable because the hardware you need to participate is scarce, but anyone could essentially do it.
Theoretically.
Yeah. Ethereum is probably the most decentralized in participation, and like anyone with some reasonable consumer hardware can participate. And Solana is one of those things where you need not only permission, but a significant capital to run the hardware and bandwidth to participate.
I think,
right? So you have this weird trade-off.
Yeah. Most importantly, it almost feels like to me that now is a reversion. It's kind of, you've now gotten your institutional money involved, and it's the boys club again.
Yeah, and I think this is just a natural cadence of humans where we have this like pendulum swing. And so the beginning of Bitcoin was a very much decentralize all the things at all costs. And then we tried to do that with everything. And it turns out some things just can't work that way. It's too inefficient. It's too cumbersome. It isn't necessary. Like I don't need a nation state resistant ledger to prove to you that I bought a donut today. So for some applications, it's overkill. And now since Bitcoin and our experimentation, we're expanding and specializing in a lot of ways and building technology that's appropriate for different things. What becomes difficult is our ability to, like, as just a casual investor, how do you evaluate that? How do you do due diligence to see what's the appropriate thing for different use cases? That becomes a little more difficult.
So is that really why we keep seeing all these new cryptocurrencies? And let me ask this question. For every crypto coin that we see to pop up on a Coinbase or on a OKX or any of these other platforms that are more familiar, is there a corresponding blockchain to that?
It's a great question. And the answer is absolutely not. By the vast majority, most coins are smart contracts on either Ethereum or Solana.
Okay. So they have a different name, but they're
one of the things that smart contracts enabled was which has allowed us to make a coin. Most coins are usually just smart contracts, just because all it is a ledger, a registry of a coin number and some address. And that's something you can do with a smart contract. And then you manage it through transactions on the underlying infrastructure. And that's why I think infrastructure level blockchains are the things that matter right now, is because they're the ones that are being built on. They're the ones that are providing services to other things and businesses that exist. And so I look at them closer to like public good infrastructure that people get to use in a permissionless way. And so when you think about almost all coins, except for a handful of infrastructure, layer one coins, they're just using an underlying technology like Ethereum or Solana to make that happen. And what that also means is that the rules in which they're governed are arbitrary. They can make up whatever rules they want to their coin, the inflation rate, whether or not they can pause it, whether or not they can take your money without asking, whether or not they can change the rules at any given point in time. All that stuff is arbitrary to the coin. And so the ability to do diligence is a little more difficult. You have to look at that coin, the smart contracts, all the stuff around it, and measure that against the marketing that they do. And this transitioned nicely into another one of the applications that a lot of, I think, casual investors have heard of, and we hear a lot about within government strategy, is stablecoins. Stablecoins are just smart contracts on a different chain. It's just they're pegged by some collateral. What that collateral is arbitrary. What the rules of it are arbitrary. And so it's going to take a while, I think, for us to come to some level of confidence that this thing will stick around for a long period of time.
So what's the value? So the stable coin that comes to mind is the USD, which is supposed to be pegged to the US dollar.
Which one? USDT?
USDT.
Yeah, that's
Pegged to, right, tethered to the US dollar. And that is its explicit purpose. But if we have the US dollar and it's still the world's currency as it is today, why do you need the USDT as a representation of that?
because it puts it in that
In that
digitally native
ecosystem.
form, right? Like right
So
now,
it's
if
a
I have
representation.
US dollar,
I have to convert it to something
I got to make it digital somehow or another
in order to put it.
in order
to
to start
use.
using all of the stuff that's available that this technology provides. And USDT is an interesting one when it comes to like risk assessment, because it's massive in terms of the amount of infrastructure that relies on it as a stable coin, and its history is very sketchy and apparently inauditable. So that's one of, I think, the major risks of people need to look out for, is like how stable coins stay pegged to a dollar, because that's its only function. And then historically speaking, I think all but maybe two of them have become unpegged, where they lose the mechanism that keeps them stable breaks.
This sounds almost like the money market and breaking the buck with the money market accounts.
So fortunately, it's more transparent. You can kind of watch it a little better than, I think, previous attempts at doing things like this. And like I said, how they do it is relatively arbitrary. And so if you look at one stable coin and understand the method in which it stays stable and the assets that back it, that maintain that stability, because usually it's tied to some real world asset you're trusting.
A
lives
fiat
somewhere.
currency.
Gold assets like the IMF index. It's
So it could
arbitrary.
be any arbitrary real world asset. Okay.
So once you understand that, it's not transferable to all of them.
Just to that,
Just to
whatever that
one.
thing is.
Yeah. And so it takes a lot more understanding to have confidence that you can depend on it maintaining that same value over its lifetime. But that's its whole point, though.
So if I'm an investor, how do I view cryptocurrencies in the realm of my portfolio? Is it part of the portfolio? Is it separate from the portfolio? Is it not actually an investment at all? How would you tell someone to look at that as part of their overall portfolio or not?
So as a disclaimer, I am not a financial advisor, but when I talk about these things and I try to give people a good way to think about it, I say like it's always going to be subjective based on what you have available to you to invest and how you manage risk assessment, what your tolerances are, things like this. In my opinion, it should be a portion of everyone's portfolio, and its allocation is in the high risk of the high risk section of that portfolio. This is a high risk investment, and relative to the high risk category, it's on the high risk portion of that too. And then once you kind of are okay with that, starting to put it on your balance sheet or put it in your portfolio, you can do as necessary. There's ways about going about that, depending on how often you want to look at it, how much you want to make sure it's stable, what your risk assessment is, that type of stuff. But I think everyone should have a portion of it, because I do believe that this technology will become the infrastructure that we use for finance. If the internet exists, this is its native way of moving value around.
So in your mind, is there any chance that crypto goes away?
Not at all.
It's here to stay.
Percent. Without a doubt in my mind. I'm dedicating the rest of my life to making sure.
Well, you're a chief evangelist.
But like, I will say, and what I like to say is that it will be around, but in 5 years, I don't know what it's going to be called, because if they look at the breakneck pace of innovation that's happened just since Bitcoin started, I used to be able to, as an individual, keep track of every single thing that happened. I understood completely the entire movement of the industry as a hobby. And now, as someone who spends every waking moment trying to keep track of things, it's hopeless to even understand a portion of it. It's so big and so broad that it's just, I think, a natural development of an exponential technology. It's like AI, right? In the old days, AI has been around for a long time. It hit this kind of shelling point where it became something that everyone talks about and understands, but also the rate of innovation of AI exploded. So now, even as a specialist, you can't keep track of what the bleeding edge is. You have to specialize. Bitcoin is one of those things. They're kind of diametrically opposed to each other.
Okay, but is it Bitcoin specifically? Is it crypto specifically? Would you tell someone to invest in Ethereum versus Bitcoin, or have all of those, or Solana? Is it you get a index fund that's going to cover the market? Like how would you say the best way to go about it would be?
My general thought is, if you want to just get exposure to it, think about the infrastructure plays. Like, which ones can you have confidence will be here 5-10 years from now? And those are the layer 1 coins: Bitcoin, Ethereum, Solana are my main 3 that I
So your
think are going to
feeling
stick
is
around.
they're going to stick around.
They're going to stick
in
around.
some
I have
form.
confidence that I can build something on them today, and they're going to be here in 5 or 10 years. Everything else, I have no confidence in to say that.
And again,
that means you have to keep track of it a little closer. You have to check in with it. You have to make sure that the changes that are happening within whatever that thing you're investing in are along the lines of whatever you're comfortable with. And so if you want to have a real hands-off portfolio, you don't want to be investing in those things.
And to be clear, as you said, you're not an advisor. And obviously that's why our whole industry, which is heavily regulated, is still trying to wrap their hands around how to do that. Because in our world, it's never a comfortable position to go, hey, we think you should invest in something and it's probably going to go to zero, right? And so I think that's why there's a lot of interest around it. But up until this point, and we're starting to get more adoption. We're starting to see more ETFs, like you said. You know, recently you're seeing more of your largest banks allowing this in client portfolios, right? Some of your largest financial institutions. So I do think that the financial industry recognizes that it is a real asset in some way, however you define that. It's not going anywhere. And so we have to start having conversations around it. But it is interesting because I think hearing from you that you don't have a high confidence level in exactly what this thing will look like 5 or 10 years from now. For the rest of it's just kind of like, well, then we have no shot at knowing. So interesting. So let's talk a little bit about FTX, because I don't think a lot of us really understand what happened there. I mean, we saw the headlines. It was massive. It was in the billions. Obviously, there was some commingling of funds around companies, but talk about FTX as it relates to crypto and blockchain.
That's a great story, actually. So FTX was an exchange, and it was a custodial exchange, meaning that...
So it was like a Coinbase.
It was like a Coinbase in that I sign up for an account, and when I, quote unquote, buy crypto, they're managing it for me. They own the keys. They're doing the accounting. They're making sure everything... They're actually doing all of that for me, and then exposing how much I have access to via some website or something, right? Application. They're not... And it's hard to say how well they do that. They're kind of this institution that's built on top of the technology that knows how to talk to it, interact with it. But whether or not your account is a wallet on the chain and they're managing your keys for you, or you're just some entry in a database, is kind of arbitrary and up to them to figure out.
So almost, I would liken that to a separately managed account versus a pooled investment. So the wallet would be, you have your own distinct account, you have your own keys, your own asset in there, and that is yours and managed separately, versus, hey, we've got this pool of keys, this pool of assets, and then all these people own it, and we've just got a ledger that shows how much of that they own.
So what you're doing when you're signing up for something like that is you're trusting the institution to do that well. Here, I'm giving you this money. I'm telling you what I would like. I'm assuming and trusting you're going to do that such that when I want to pull this money out, it will be there. And Sam Bankman-Fried did not do a very good job of that. They were very poor custodians of all of their customers' money. In fact, they were using their customers' money to do trades in a side business. They were funneling their money from FTX into a separate entity and doing trades with that, and caught doing it. And what I find interesting is that the hallmarks of the benefits of blockchain and crypto were actually the reasons why we were able to figure it out. So when we talk about transparency and tamper evidence and the ability to audit this type of technology, those are the tools that allowed us to have proof that that's what was going on. Without that, it would have been very difficult to make the case that that's what was happening. And when you read a lot of news, I don't think they point to that concept out, is that this instance is perfect for showcasing the value of using blockchain as infrastructure for finance, because it gives us the tools to prove when malfeasance happens. So they're just a traditional financial institution that happened to use Bitcoin or cryptocurrency. And because of that use, we were able to show that they were fraudsters. And I would argue, without that we would never have been able to prove.
Wow. So I want to touch back a little bit on blockchain technology. Where do you see it going? And where do you see private business use? I've got some ideas of opportunities within the government, but where do you, if you were to make a prognostication on where you'll see the earlier adopters or the earliest adopters in mainstream stuff, where would you see that?
So as it stands today, all of these networks are not private. So they're fully transparent. I can see where all coins go and trace the history of those coins back to the beginning of the network.
So can you see everyone's net worth on that?
Assuming I know their address, yes.
Okay. So there's no,
and there's a lot of forensics
privacy.
tools around grouping addresses together so that I know that it's the same person. There's a lot of effort.
and I'd imagine with AI now, you could have that crawl
That's
this
only
stuff
exacerbated.
easily say, hey, tell me how much Corey Petty has on
Yes.
the system.
That's become, it's so in terms of like, I don't want to say financial surveillance tool. It is. It's just very transparent by the nature of how it works. So that being said, until privacy is introduced into the nature of how these things work, you're not going to see a lot of businesses who need to maintain business secrets leverage them too much.
Same thing with government then, I
Yeah.
guess, as well.
Well, I would argue that privacy for the individual, transparency for the institution.
Yes.
So in the areas in which we need transparency on social funds,
Yeah.
how the government spends its money, things like this. Voting is also an interesting use case here. That's where this technology has potential to really drastically improve the efficiency of how things work today. When we're able to take the middlemen out, we take the costs out, we take the introduction for abuse of power out, fraud, all these things that we know exists.
They can't.
It becomes
happen
so
on a
difficult to prove, and so nothing happens. In my opinion, this technology is what can make that better and nothing else.
But an application like the IRS, where more privacy is important, maybe that takes a little bit longer in terms of how it interacts with the individuals.
Yeah. So until we
Right.
figure out privacy, which is a big part of what we do as an organization, is find a way to introduce privacy natively into this technology. A lot of the use cases that it can be good at won't be, because people need
that
privacy. Like you need to be able to expose information at the right level. If you're forced to expose everything at the very bottom of the infrastructure, you can't build anything on top that requires some level of privacy.
Or
You can't build
security.
privacy on top of something that isn't private.
Yeah.
And so we have some time to get to that, because that's hard.
Doesn't that go against the whole idea of the blockchain technology?
Nope. That's the interesting part. It's
Okay.
like with cryptography, like cryptography is this it's magic that it still gives us this fair democratization in a way that shields information from being exposed. Like, for instance, this concept called zero knowledge technology, zero knowledge cryptography, allows me to do things like, say, for instance, I want to prove to you that I'm above the age of 18. How would I do that today?
Show a ID.
I'd have to give you my ID,
That's right.
which in the process of doing so gives you a lot more information.
Then
Just whether, not even my age, telling you my age still gives you more information you need to know. You just need to know that I'm above 18.
so yes or no.
It's a yes or no.
Okay.
And you need to be, and so this type of cryptography allows me to prove just that without telling you anything else.
Are you over 18? Yes.
And you have perfect confidence that that's true. And so we can do that with almost arbitrary information. And so with these types of tools that we're getting better at using and learning about and discovering, we can build blockchain systems that give us this fair, equitable group consensus, how to build finance and governance and stuff on top of, while still having some level of privacy. And that's a relatively recent discovery and innovation that we're learning how to use and make more efficient and so on and so forth.
Interesting.
So like, I think now where things scale without privacy, we can have a lot of really cool things that are needed when transparency is wanted. Till you get privacy, you're not going to get, I think, the big level ups of businesses participating, building on top of it, stuff like that.
So once we build in the privacy, you think that's when we'll get adoption by sovereign nations, governments, that kind of thing? I think there's a big fear out there that the US government will overregulate it. Don't really know what that means, but talk about some of that. I know Brian Armstrong, the CEO of Coinbase, has been a big proponent of trying to lead the way to get this more mainstream, recognizing that without government support, there will continue to be headwinds. Kind of talk on that.
Yeah, I mean, without clear regulatory guidelines that are not too constrictive, If you over-regulate, you then keep businesses from participating and innovating and building and growing what we can do with this type of stuff. But if you under-regulate, you have uncertainty, and so people won't participate because they don't know there's no confidence that they're not going to, be murdered by taxes later on down the line when a decision is eventually made. And so you need to strike that nice balance of like, how do we make sure that this stuff, you keep fraudsters, scams, etc., from just proliferating like they do today, while not stifling innovation. And I don't know where that boundary is. And I think only recently have we even started to have reasonable conversations about it. I don't think the government's had enough time to catch up, especially with the breakneck speed of innovation, but it's starting to look a lot better. And it's hard to know what that looks like for me because, like I said, I think most of the institutions should be transparent. So we can start doing a lot of things today that allow for adoption, drastic efficiencies in how governance works, and allowing for businesses to be confident in building on it, leveraging it, and innovating on it. But a lot of the interesting use cases for me don't happen until we have privacy, but that becomes a double-edged sword because it's much more difficult to regulate something you can't see.
Okay, so I want to go full circle now that we've gotten more clarity. So you're chief evangelist at Logos. Logos is a company that's built on the Ethereum platform.
Nope.
No? Okay. Walk me through what Logos is today and what the goal of that is. And then you also mentioned this term, the IFT, the Institution of Free Technology. Kind of where does that fit into all of this?
The IFT is kind of this, I don't know the right
self-regulatory body.
It's like a management firm. It's like a it's a way of allocating funds to various projects under a certain set of guiding principles. Like we have things that we want to exist, and we have a number of projects that push in those directions.
So what is this IFT? Where is it formed? Who is it? Is it a bunch of companies? Is it a bunch of individuals?
It's a bunch of individuals.
Just concerned kind of citizens?
So Status was the original project. That then grew into as the software project grew,
what software? We'll go back.
And Status was, I call it an ICO, or initial coin offering on Ethereum.
Okay.
So
Status was a coin.
Yeah, it still is.
Okay.
You could buy that. It's S&T. And the idea was to build a mobile interface to Ethereum. So we wanted to try and make it easy for people to use Ethereum on their mobile devices. And that's required a lot of work because there's a lot of other things you need.
Is that like a Stripe, a PayPal?
It's like WeChat.
Okay. WeChat being like the Chinese.
Yeah. That like
everything. So they'll pay their rent on that. They'll pay their water bill on that. They'll talk about the community watch program on there. They'll put their shopping list on there. They'll do all of that.
The super app is the general term for it. It's just we're not tied to anything. We can't control what users do. We can't see what users do. It's the same concept of a super app, but no underlying surveillance to it.
So we're building this super app for what purpose? Convenience?
To democratize access. Like if we want people to use the technology, because in the event we want to build something that the technology uses, people need to have access to it in an intuitive way. And right now it's so difficult to use. So how you package that up in a way that's intuitive and simple and gives people the right information to make good decisions is a difficult thing to do. So that was the idea of that project.
Because who determines what the right information is, right?
It's so subjective to the person.
Okay, so you guys, this ICO, this Status coin was born. That was the initial coin offering. Obviously, it got some traction, right? And then from there was these coins were purchased, and so money changed hands, and out of that, Logos was born?
Kind of. So what happened was, in order to make a super app, especially with the kind of principles that we had, where like it's self-sovereign, decentralized, you can't stop it, we can't control it. We can't take your money from you. There's other parts of infrastructure that need to be built too, which was messaging and storage. And so we set out to also build that infrastructure. And we have done a number of that. And as the need for that continued to grow, kind of grew beyond the original mandate of what Status wanted to be. They want to be an interface. And so we built out a separate portion of the organization to be called Logos. And that project is essentially providing the infrastructure required to build decentralized application.
But you're not doing that on the Ethereum network.
We use it, and we also have we're building our own, which is...
You're building your own blockchain.
So the way in which Ethereum grew over time, it optimized for scale. It had so many users, it would slow down the chain, all these types of things. And so all of the innovation that they put forth was like, how do we grow the capacity of the network? How do we make it so more people can use it at the same time? And similarly, decentralized and cheap and fast manner. So all of the effort went in that direction. Well, a lot of what we still believe is that in order for this stuff to be ultimately adopted and useful, privacy still needs to be a major concern. And you can't bolt on privacy in the end. It has to be built from the ground up. And so we've started an initiative to
build your own blockchain that is specific to focused on the privacy.
maintains privacy lower down into the technology. So that way, when you want to disclose information, you have that option to do so at whatever level you need to.
So then the hope would be you could then turn around and sell this technology or sell the use of this technology to a government, a sovereign nation.
They can build on it and use it.
A financial institution because it has the privacy that some of these other blockchains have been missing.
Hey, we want to build a playground that people can use. And then when you foster that type of ability to innovate, there's a lot of opportunity for new types of businesses to be made, new governance opportunities, like new ways in which people can govern themselves, all kinds of things that it's like a kind of an a hotbed for exploration. And because it's a blockchain, you have value transfer built into it. And so we want to build something that we think allows for the type of innovation that can't be done anywhere else because it has privacy.
So if we are encouraging our folks and folks that have less of an understanding of this world today, what resources or where would you point them to really start getting a more firm understanding of crypto technologies, blockchains, etc.?
That's always been a hard one for me because when you search for this stuff, the quality of information that comes out is usually quite terrible. I run a podcast called the Bitcoin Podcast. Well, I run a number of them. Hashing it out, which is much more technical. So it's a kind of unapologetically technical podcast. The Bitcoin Podcast, which is more infotainment. It's topical. We go on tangents. It's not necessarily, you're not guaranteed to get information you want. And we don't ever talk about price. So you're never getting that. And then I do a lot of videos for Logos and the IFT as well, which you can see from the website logos.co. And as far as like written information, that's a hard one. I don't really trust anything that comes out from the media companies and the industry.
Okay. One other question that just popped up, because this is another term that I think we hear a lot. Staking. Explain what staking is.
Okay, great one. So we talked about mining.
Yes.
In order to do mining, in order to participate in that Sudoku game, right? You're solving that puzzle. You need to buy specific hardware. They're called ASICs, and they're called application-specific integrated circuits. That's what ASIC stands for. And these are very specialized computers that do one thing and one thing only. And that is that particular cryptography required to solve that puzzle, 56 hashing algorithm in specific. That's all it does. It's the whole industry is built around building these specific machines that do that as efficiently as possible. So that way, and that's what you use to mine. And that is when you hear about like these networks are so inefficient, they take a nation state to run. It's running those machines. Those machines, it's an incredible amount of power that goes into searching for that next puzzle so that you can add the next block. So one of the innovations that happened to combat that required energy to participate was called proof of stake. That's called proof of work. When you solve that puzzle, you've proved that you've done some work.
Yeah.
You've applied a bunch of real world energy to this computing problem, found the solution, and there's no other way to do it than to apply brute force energy to it. That's called proof of work. Proof of stake was this digital voting process. So instead of using computers applying energy, we're going to come up with this interesting voting process. But in order to participate, you have to put up stake because we need to have weight behind the people who are participating. And if you cheat, we get to take that away. So in order to participate in this voting process called staking, well, staking is how you gain your entry ticket. You deposit coins into some contract and you lock them up. You stake them. That's what staking is. And then once you prove you do that, you then say, all right, I've staked it. I'm now a participant in this voting mechanism. That winner gets to introduce the next block. So instead of having all this extra extraneous power being delivered to the network in order to find the next block, you have a voting process. And how you do that is complicated and different between networks. That's the general idea. I'm putting this up as stake. So now I get to participate. If I'm caught cheating, you get to take that stake away. So there's something at stake for me. There's a risk for cheating.
But when I go into my Coinbase account, I'm given the option to stake my coins. I'm not validating the network. So I'm getting paid
Well,
do it.
they're doing it using your money. Coinbase is doing it on behalf of you. They're running all those validators. And one of the projects that we have under the IFT is called Nimbus, which makes that software. So we make the software that institutions run, or one of the pieces of software that institutions run in order to do staking on Ethereum.
So if I am allowing Coinbase to stake my coins and they screw up, could I lose my coins?
I mean, under terms and conditions, potentially. But with Ethereum, it's kind of hard. They've made it pretty conservative in what you have to do in order to like lose all your coins. My intuition is that they wouldn't fault you for their mistake. They'll make you whole, but there's no guarantee for that. I don't know. I don't know what the terms and conditions are, but effectively you're trusting them to do it.
Okay.
And then they just feed you off a portion of the revenue they gain from it.
That's right. That's your rate of return on your staking there. Interesting. Okay. So you've talked about a lot of energy. Is there any relationship between the mining and the validating with crypto and the blockchain and the tokens and the power needed for AI with the data centers? Are they related at all?
Not a clue with each other.
Okay, so they're not related at all, but we have two significant things right now in our country that are demanding immense amount of power.
And you have the word tokens in them,
Right.
which are also vastly different.
Okay.
So unfortunately, and I don't think this is going to be possible, though people are looking into it, people have often tried to find a way to make the energy that's used in mining useful. Because right now, all you're doing is brute forcing a puzzle that is not useful for anything else than solving that one puzzle. You can't apply it to like protein folding or all this other type of computationally intensive work that we'd like to do as scientists and like kind of pushing science forward with computation. All the stuff that we'd like to do with computational science, we can't apply towards a mining process because it has to be fair and distributable. Like this property that anyone can do it. And even if I start mining on my laptop, I still have a modicum of a chance at winning. But that energy distribution has to be very fair. And no other computational task is that fair. And so the energy required to mine Bitcoin can't be used for anything else. The energy required to run these inference machines or these AI machines or LLMs is very specific to that particular type of problem and also specialized, but I don't see a way in which we can kind of reuse it for mining in any way, shape, or form. So they're just going to be two completely different tasks that unfortunately require a lot of energy because like Bitcoin's not going anywhere. Bitcoin will never move from proof of work, meaning that it's going to always require these machines to take energy from the outside world and pump it into the network because that's the guarantee you're getting on why it can't be rolled back is that you need that much energy to roll it back. So yeah, and then the tokens is a different.
So they're both have the terminology
Mutually
token,
exclusive,
but they have nothing to do with 100%. One another. So
yeah.
they just it's a confusing overlapping term.
Yep. There are mixtures of kind of how these things can marry each other that people are playing with. It's an eventuality because cryptocurrency is a native value, native way to transfer value on the internet digitally. It allows you to build economies around AI agents and things like this, which is interesting to play with, but we have yet to see how that's all going to work out.
Well, Corey, certainly appreciate your time today. This has been invaluable in terms of just learning and understanding and breaking down some of the most basic concepts which are thrown around but not really clarified for the general audience. So I certainly do appreciate your time today and the opportunity to pick your brain.
Happy to be here. Thanks for having me.